Hey, good morning. Hey now. All right. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance. Why? Why? Because trading is risky. Did you know that? It's not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money, cannot afford to lose. Hey, my name is Wayne. Really nice to see you. I want to start by saying peace on earth. I say it every day, but it's extra important to be able to say it today. Anyway, so what are we going to do? We're going to look at the markets. We have long-term trends and seasonality. We have geopolitical risk. We got a lot going on technically and fundamentally. It's also earnings season. So we got lots going on and lots of cross currents. So it's going to be a challenging day. It's going to be a challenging week. It's going to be a challenging quarter. So anyways, I'm very grateful that we have our community and that we can go through all the data technically and fundamentally together, and that we can trade through these times of duress as a community and not, isolated. So anyways, thank you for being a subscriber of Forex.Today and everything you do. I'd like to point you to some resources that are available. You'll see them in the description below the video. In fact, I should probably just try pulling up the description. Can I do it? Oh, I have to click over here and go edit. Oh, yeah, so there's a lot. First of all, I'll start since it's already here. Tradersway.com. They're a foreign exchange broker. They also have crypto and commodities. Okay, some stock indices. Yeah, really good. You should check them out. They're an ECN, so they don't trade against you. They enter your trades into the interbanking system. I trust them. I recommend them. Check them out. I'm doing a stock trading course today. Oops, that's funny. Oh, because it thinks I'm already in. Anyways, I'm doing a stock trading course. I'm not going to be able to do today. Typically, we do Wednesdays, but I think I'm sick. So anyways, I'm not going to be able to do it today, but there's already about 5 hours, I think, in the course. So you should check that out. I know it's just a checkout page. It doesn't tell you anything. Well, I'm teaching you the principles of stock trading. Okay, tradeplans.ai. It's a free resource. You pop up a trade plan, and you get instant feedback from artificial intelligence. Okay? That description is below the video. Here's another interesting one. This is about a 2-hour webinar, about an hour and a half maybe, hour and a half. 3 trading secrets that may triple your trading profits without changing your indicators and while spending less time at your charts. Yeah, it's pretty cool. It's actually pretty cool. It shows you how to do your fundamental analysis properly. What else? There's so many. There's another link. InvestorBootcamp.com. 88 hours of training videos for $88 per year. Not per month, per year. Amazing deal, honestly. You should consider them. So these are all resources. You shouldn't be spending your time trying to figure things out. You shouldn't be spending your time looking for tricks and ways to cut corners. You should invest your time in resources and learning how to understand what's going on. Oh, thank you, Ashish. Yeah, I don't really get sick, but I get really tired. And then I sneezed a couple of times and I coughed a couple of times, and I'm like, huh. But, I just went to a conference and, been around hundreds of people for an entire weekend. And, that'll do it. You know what I mean? That'll do it. So anyways, yep. We'll see how today goes, how the bond market goes. We had a big move in the bond market yesterday. And now there's geopolitical risk with Grandpa Biden in the Middle East, so we got to pay attention to that. Earnings season, there's Tesla, and a few others today. So there's going to be some volatility in about an hour. The volatility will start kicking in. Is it 8:12? Yeah, that's good. It's still on time. I haven't worn this watch in a long time. Cool. All right. Yeah, boy. Let's go through the markets. Okay. The Dow is riding the 4-hour 21 just nicely. The S&P is trying. It's been pulled down a little more. And then let's go to the NASI. Okay. And yeah, it's through. I guess I'm going to have to zoom in to try to get the same kind of look. And what you're seeing here is the Dow's riding the 21. The S&P 500 is through the 21. And the NASDAQ's pulled down past even the 55. What does this tell you? Well, they have a relationship with each other, but also the beta is different. Let me get this coffee down. So the beta is different. If you wanted to define these as market, so the beta. Another way you could look at it is the sigma is different, or the standard deviation is different, which is the square of the sigma. And these are different measures of risk and volatility. And as you go from left to right, okay, the statistical analysis shows more and more volatility in the profile of these indices. And so the Dow has the least amount, and it's slow and steady, steady and slow. It's climbing the 21 EMA. It's not great, but because there's less volatility, it's just climbing as it normally would this time of year. Nothing exciting, no big ups, but no big downs. S&P 500 is trying the same thing, but you see there's more big ups and more big downs. And then NASDAQ's even more big ups and big downs. Big ups followed by big downs. And the downs are greater because we're at, let's say the 55. here we're between the 21 and 55, and here we're on the 21. You see? Showing that least amount of pullback, moderate pullback, greater pullback. But if this turns bullish, it's going to be very bullish. But if it turns bearish, it's going to be very bearish. This will be less bearish, and this will be moderately bearish. This is important in portfolio construction. So anyways. Cool. I've unofficially been asked to help manage an endowment for a nonprofit. And so these kinds of topics I would have to discuss if I was going to be a strategist to the board. Oh, and then speaking about the board, the Council of Investment Advisors. Is anyone thinking about joining that? Lots of people have told me they were interested, and then I created it, and then I've sent them 5 emails, and then they don't respond. So I don't know what's going on there. But is anyone interested in learning actually how to do stuff like that? Manage, construct, manage a portfolio like an endowment? Well, we're meeting in December. I haven't sent out an email in a couple of weeks, so I apologize to everybody in. But we are starting. There is $50,000 in an account at a major Wall Street institution of my money. And we're going to turn it into $1 million together over the next few years, and we're going to manage it like an endowment. We're going to have lower volatility than even the Dow, and we're going to have higher returns than even the NASDAQ. So I want lower risks and higher returns, but not at the cost of consistency. The money will live in perpetuity. And so over the weekend at this nonprofit conference that I went to, we raised in an endowment, or they raised an endowment of $300,000 for a friend of mine who was a really amazing person. And when I knew her in her 20s, early 20s, so she might have been 20 when I met her. Well, she died not long ago of cancer and left her husband and 2 children behind. So we raised an endowment in her honor, and that endowment needs to live forever. That money needs to grow, and as more alumni contribute, the account will grow from $300,000 to $400,000 to $500,000 over time, just by more alumni over the period of years donate to that. But the idea is then that money generates an income, and then that income can be invested into the nonprofit organization. In this case, it's focused on leadership at the college kid level or age. So again, 20-year-olds. So we could pay with that money for them to go to conferences internationally and all that kind of stuff. So that money really needs to live forever, and so that's the intent. And that as more alumni over the years contribute more, the Alumni Association can do more for the overall nonprofit, you see? So it's real. Like, this is a real thing. This is a needed real thing of knowing how to truly analyze the stock market as well as the macroeconomic market conditions, and be able to construct a portfolio that can produce a return and lower risk. Because usually, like a hedge fund, they want to make a lot of money, so they take a lot of risk. I don't like that. I don't want to make a lot of money. I want consistent returns And I want low risk, low volatility, but an ability to generate income. So anyways, I'm going to teach you how to do it. We have what, 7 members of the CIA, and I'd like to get this closer to 25 because we meet every few months, about 4 times a year. We're going to meet and go over the macroeconomic conditions. Okay, look and analyze the results of our previous investments. I'll introduce new investments and the prospectuses around them. We can have conversations about how we should invest this money in the near future because of the changing market conditions, and make decisions on how to, rotate money out of certain investments and add new and reduce some, and truly manage this money and grow it over time. I will be doing this for the nonprofit where I could do all of this work. And basically what I could do, if you think about this, the work that I do at the CIA to manage my own endowment, if you will, it's a retirement account. But to manage that money, we have to do all the work. We have to do all the research. We have to analyze market conditions. We have to think about these investments and rotate the cash into different things based on our outlook for the next 3 months. When I'm done, I basically can take the same analysis and go straight over to the nonprofit organization and present it to the board, just because this is how it works. I would present to the board as the investment advisor or strategist, take all that same information that we talked about. And so my account will grow from 50 grand to $1 million. Ideally, this nonprofit will grow their account from, let's say, 300,000 to $1 million, or millions, because of the work that we do together. How many people would like that type of experience where you're actually doing? You're actually discussing with other investment advisors, including myself, the real world and actually deploying real capital. This is what this group is about. And it's not about Forex. So anyways, so on December 12th, we are meeting in Nashville, and we're going to make decisions on how I should rebalance my portfolio based on the likely risks of the next 3 to 6 months. That's why I'm doing the stock trading course. So if we had 25 members, probably every meeting in person would get 8 to 10 people in person. And that seems ideal to me. And the rest can attend from their laptops. So anyway, so it's real world, I'm telling you. I'm doing this for real. Do you want to learn how? Okay. Okay, we had that big spike on oil. You probably know about it. It's come back a bit. Check your 4H. Okay. The predictive 4H is right around 87. So if we're going to use price action, and it's worked so beautifully recently, we're getting pretty close to the new buy. Somewhere between 88 and 87 seems like the number. Okay. By the way, is anyone actually interested? Two people said yes. Frank said soon. But like, no joke, is anyone actually going to join? Like I said before, about 9 people, besides the people that joined, said they were interested, and I've emailed them, and they don't respond. They're interested, but they don't do anything. Are you interested in actually managing money? Yeah, Greg. Greg, look, Greg, I don't disagree with you. So let's talk about that. So Greg's like, it's probably not a good opportunity or time to invest in the stock market. Um, we have a lot of risks, right? And one of them is, recession is coming. We are going to go into recession. The bigger question is, are we entering recession now, or is it going to be early next year? And so, like, if the answer is early next year, right, Greg, like, there's still an opportunity to deploy capital now. Now, is it the stock market? Maybe. So seasonally, we know actually last week was an amazing time to put money in the market. Well, you could also put money into a 10-year T-note and get almost 5%. Well, that could be a way to deploy capital. If not now, certainly between now and the end of the year, that might actually be a really good opportunity. In the meantime, you can leave your money in a money market and earn 5%, right? We face geopolitical risks out of the Middle East. Yes. Global economic contraction. Yes. China collapse. Yes. These are all real concerns. But at the same time, very often you do have to deploy capital, right? I mean, look, you sitting on cash. I mean, I guess that's an investment decision, but would you sit on, when people say, when they say that, I'm like, are you really in cash? And they're like, no, I'm in the money market. Oh, okay, well, okay, that's not cash. So Greg's like, I think what you're saying, Greg, is that there's a lot of risk, and the stock market may not be the best. Okay, be the best opportunity. Well, it hasn't crashed yet, per se. So one thing that can be done, Greg, is, let's say you do expose some of your portfolio to the various stock markets around the world, whether they're American stock markets or European stock markets or Asian stock markets, for example. But then as market conditions change or economic conditions change, which is different. Market and economics are two different things. It's like what prices are doing now versus, again, it's kind of like, what do you see on your charts and what do you see on Quant-in-a-Box? Sometimes they don't agree with each other. They're both right. There's one like sort of long-term versus short-term, right? So if things change, right, Greg, and you happen to be overexposed, not just to the market, but like which market or which beta. Okay. And what is your exposure? So like taking Greg's comments, right? Like I said, I'm not disagreeing with Greg at all. In fact, I'm agreeing with Greg. But like if your time horizon, Greg, was 25 years, because that's when you're going to retire 25 years from now, I would let the stock market fall and dollar cost average it. It's not a trade. See, I don't add to losers in trading, but for those that are not going to actively manage a portfolio, you don't want to miss the drops in the stock market. When they drop 20, 30, 40%, you want to actually, that's when you want to be buying. And most people do the opposite of what they should. Okay, they sell at the bottom and they buy at the top. So if instead you had an automated process of, $5,000 a month, every month you buy the stock market, then you sort of just average it and you buy the beta, and you're living through the business cycles, right? And on the long run, in 25 years, what we've seen over time is you're going to do very well. And it's those that try to time the market a little more, they tend to, when you're not a professional trader, I mean, this is cliche, but it's a cliche for a reason. People hold on to the losers and then they don't buy at the bottom, right? So if you could take care of that, you just always buy and just, and this is what every wealth manager tells you. Buy buy diversification and just consistently buy good, bad, and ugly. Just keep buying. Okay. Now the next step, and of course now we're more professional, right? So we say, no. We understand the business cycle. We understand geopolitical risks. We understand global macroeconomics and the timing of these things. And we understand things like seasonality. So there are appropriate times to hold additional risk, and there are appropriate times to hold less risk. There's always going to be risk. Even a money market has risk tied to it. Even a 2-year treasury paying 5.15 has risk, because I'm certain in 2 years that'll be significantly less. So that's what's working now. What will be working in 6 months? What will be working in 12 months? What will be working in 24 months, right, Greg? And that's where now it gets interesting. Okay? So I don't disagree that we have risk and that there is a likely outcome of the stock market coming down. But I think that process, now the geopolitical risk changes everything, but the process of the decline in the stock market probably won't happen until January or July. And typically it doesn't happen in October. But like you say, there's real risk, both technically and fundamentally, and now we have more risk. But I know there's going to be a recession next year. I know the Fed knows there's going to be a recession next year. The thing is, it's not supposed to be now. And when you analyze the United States economy, besides this geopolitical risk, what do we have? Non-farm payrolls adding 336,000 jobs. Inflation is through the roof still, but way better than the rest of the world. We're only at 3.6. The UK is at 7. The UK has double the inflation of the United States. So relatively speaking, the U.S. is doing good there. We just got retail sales. Americans are spending the money. So the recession is starting, but it's not grabbing hold yet in the markets. So I totally agree. But what I'm trying to do, Greg, as let's say an economist or a money manager or a trader, is I'm like, okay, I need to have that healthy fear, but I need to be as rational as possible. And this might change in the next 3 days based on everything that's happening in the geopolitical risk world. But barring that, I would intend to maintain, let's say, normal seasonality of investment strategies, and then probably at the December 12th meeting of the Council of Investment Advisors. Again, so now we have the CIA that's going to help manage my money, like an endowment. And we will look at what has changed between now and then. What are the economic conditions? Are we already in a recession, or will there be a recession early next year? We'll look at the facts as a CIA. We will discuss them. We will maybe debate them, if you will. We'll certainly talk about them. And then we'll make investment decisions. How should we deploy the capital? And like you're saying, well, there's a big chance of downside risk. The stock markets may fall. Well, which one will fall the furthest? Well, let's get out of that. Which one has the most risk? Like, think about it that way. If they fall because of macroeconomics and geopolitics, okay, which investments are going to be hurt the most? Which ones are going to be hurt the least? We have to at least start with that, right, Greg? So we're like, okay, so like, I'll just like NASDAQ, right? Okay, NASDAQ's going to be hurt the most. All right, let's rotate cash out of that. How much? 50% of the investment into the NASDAQ? 100%? 30%? 25%? How much money should come out of the portfolio, how much money should come out of the NASDAQ investments, because we have our likely outlook for the next 3 to 6 months is ugly for the stock market. It has the highest beta. So all of it? Okay, great. What do we do with that money? Right? Now that's the next thing, right, Greg? What would we do with that money? So let's say it's 10 grand. We pulled 10 grand out of the NASDAQ because we believe the stock market's going to fall hard. Okay, good. What do we do with the money? Leaving it in cash is not the right answer. Are you talking like what, a money market? Are we going to, right? Or am I going to, or is there a bond? Is there a bond investment that should be considered as a balance? Because remember, if the recession hits, the bond market's likely to rally and yields will come down. So maybe I rotate out of NASDAQ and I buy a 10-year or a 20-year bond and have that bond exposure replace the NASDAQ exposure inside of the portfolio. Now, NASDAQ might only be 25% of the portfolio, so now 25% comes out of NASDAQ with the higher beta, and we rotate that into 25% of the portfolio is now in the 10-year T-note, yielding almost 5%. And, well, the volatility of that would be low if you hold to maturity, right? But the thing is, I think it would go up. So anyways, right, Greg? So that would those conversations is what the CIA would be all about. And I'm assuming nobody knows nothing about anything. And so that's why I'm doing the stock trading course and will provide additional training so that we can have very intellectual conversations about money. Okay. Okay. Yippers. So I hope you guys are into that because that's truly, truly an investment, a true investment education versus, what we do here every day is trading. That's like proper, legit investment and portfolio management experience. I mean, like, that is definitely pro dog, professional level stuff. But anybody can join. Several people join. They're like, I'm not at that level. I don't know if I'm qualified. I'm like, you need to join. I'll make you qualified. Yeah. But Greg's got a lot of experience, right? Greg's been around, so, I'm just reinforcing he has his concerns, which are valid and correct in my humble opinion. The thing is, then you would have a discussion as a board. What should we do about those risks? Because ultimately, you can't go to cash because then you're not deploying your capital and you're not getting a return. And like going back to this nonprofit, if I'm managing an endowment for a nonprofit, the nonprofit needs to make money. It needs it for budgeting. You can't just say, all right, everybody, like take a couple years off because the stock market's going to be down. Or, hey, why don't you lay a few people off? The stock market's down this year, and maybe in 3 years you can hire them back. It's not how you run any organization. So we need to manage the money. So even in down periods, you got to earn your 8%. Because you need the cash, you need the income, you need the money, even on the way down. Right? So how do we do that, right, Greg? And then we would discuss it. We would look at the opportunities, we'd look at the threats, and then you'd discuss it. So anyways, lovely. Now, of course, in my account, I don't spend the money. So I combine both worlds. So I do dollar cost average, which means if the stock market drops, let's say 30% over the next 18 months, month after month after month after month, or let's say meeting after meeting after meeting after meeting, I will be contributing more capital and reinvesting all my income. So like if I make 10% and I add 10%, okay, on the way down, I'm accumulating assets. Okay, and I'm lowering my cost basis because I have well, at least a 17-year outlook. But does anyone know that when you're forced to start spending your retirement money, is it 72 and a half? Something like that. I think you can start at 67. Used to be 65. So by the time I'm retired, it probably will be 70, right? So anyways, I'm going to want to, it is 72 and a half, right? And so by the time I get there, it's probably going to be 75, right? They're going to keep changing things. Okay. Oh, Richard, you did your CFA. You got all three CFAs. That's cool, man. That's very respectable. So anyways, here we are on a buying price. Okay, we're on the buying price now. So you need to make some decisions. It's a bit low on a 15, but nonetheless, it's support. Again, I'm going to draw inside, right? You see? Okay. So email me, guys, if you're interested but not sure about the CIA. You're interested in joining. Because this is happening, I'm telling you. And I need to know, how many people are coming to the meeting. I need to know how many people are coming to the dinner. I need to know, how big of a room I need, right, for our boardroom. And this is where we're going to meet, by the way. Terrible picture, huh? This is where we're going to meet, just so you know. All right, so we got that line in the sand. Let's rotate over to gold. Gold, remember our initial target was 1918. So we got to 1930, dropped like a ton of bricks down to 1908. Higher high, higher low, higher high, higher low, higher high. Look at that. Like I drew it in advance. Okay, nice. Anyway, so now we're all the way to 1950. Okay. For those that are in my day trading group, Sunday afternoon, when I was, right, I bought gold. Okay. And I then showed everybody in the day trading group, you only have three concerns during geopolitical risk. Gold going up. Okay. Oil going up. Okay. Possibly dollar going up. Now that hasn't really quite happened yet. And Swiss franc going up. Okay. I'm like, there's normal, there's what you normally do, there's what you always do. You need to have contingency plans for this scenario. Right on, Greg. Yeah, it seems like Greg would be a fun guy to have a cigar and a whiskey with and talk about the market. So. Oh, no private jet for me, Bernd. That's not really me. Yeah, I'm far too conservative for something like that. When people come to my home, they either say it looks like a museum or like I just moved in. Like, I don't have stuff, right? I drive a used car. Yeah. So, no private jet. All right. So anyways, we're getting really close. Remember, 1955 is kind of that first kind of step. So anyways, yeah, the upper bound is between 55 and 88, really. It's maybe on our way to 2000. Cool. So Joel and Joshua, are you signing up for the CIA? Yeah. Good. Let's go. Good. I'm looking forward to it. I'd love it if you can make it to Nashville too. All right. So that's that. So we did gold. We've done oil. We've looked at the stock markets. It's a bit early to do the stock market because a lot of this is going to be, it's going to move on earnings, right? Is that right, Lucas? It'd be a real honor to have you. I respect you a lot, Lucas, and I know there are things that you know that I don't know that I want to know. So I'm looking forward to learning from you as much as sharing. So that'd be epically cool. Joel says end of November. That's cool. Email me now though, right? I'll put you on the list, kind of thing. so I can communicate with you. Also, those that have joined the CIA, I've given them the stock trading course for free because I need them to know this stuff. Okay? But I've done a lousy job of marketing and all that kind of stuff. I just, I keep saying, I have so much going on. I need to stop that. I think I got myself into a negative narrative in the back of my brain. I need to focus more on I don't have so much to do, but I need to get more done. So maybe I'll start waking up at 3:33. Sleep when I'm dead. All right. Let's move over to, what do we want to do? What do I want to do? Dollar pairs? I guess we'll do some dollar pairs. Okay. Dollar strong at the moment. Boo. But I get it. The problem is I get it. And it's really geopolitical risk. And on the political side, and I know I tried to stay non-political, but Biden has totally screwed this up. And so anyways, I think he didn't play the right moves in the strategy. I think he probably went against his own advisors and all that kind of stuff, but he ruined all the diplomacy that his diplomats have been working on for, the week and a half that this crisis has been going on. They've been doing everything you would expect a diplomat to do, and then within 5 minutes, President Biden has destroyed all that work. So now I don't know how do we get out of this. So I have some very serious concerns now. It's gone from concern to very serious concerns. Right, those in charge are making the wrong decisions. So I'm like, oh my God. So as a trader, I see this dollar strength is very possible. Okay. So anyways, and as a Canadian living in the United States who's not allowed to vote for the president, I don't think I'm overplaying. I don't want to. And by the way, I'm an entrepreneur. I don't blindly join other people's opinions. I'm an entrepreneur. I usually fight other people's opinions. Even as an economist, I don't read other people's opinions to get my opinion because I'm not interested in other people's opinions. And maybe it's I'm a Taurus, I'll do the work myself. Thank you very much, right? And I'll come up with my opinion. Thank you very much. So, anyways, I'm not, let's say, a Trump loyalist. I'm not a Republican Party member, but I do believe Biden has messed this up from a strategic point of view. Anyways, I believe that to be true. Now, of course, my own bias could be off. But anyway, so dollar strength, a week and a half ago, I said be very careful about serious dollar strength showing up as a risk-off move. And we're hitting the right slope, if you will. If dollar strength was going to show up, technically, that makes a ton of sense to me. But geopolitically, what happened in the last 12 hours, what happened last night with the hospital being blown up and Joe Biden landing there and the comments that he made and the meetings that were canceled, it's a mess. It's a mess. So I'm very concerned. Let's go back to that, right? I'm very concerned about these moves, and this is couldn't be worse. So pay attention. The only thing can save us is that Tesla has made more money than God. Maybe. I don't know. So euro dollar strong right now. Yep. Right. Lower high off of this. Once again, technically that's a terrible place for dollar strength, but it's not actually what's happening. What's happening likely is the increase in geopolitical risk. Yeah. And that pushes up oil prices. That slows the economy down. That's like, it's a big, giant, nasty gram. Okay. So suddenly, boom, we got some U.S. dollar stronger than kitty CAD. This one, we made it to the bottom. So typically in a scenario like this, because what I did here at that time, and I remember doing this earlier, I said there are two choices if you're a bull. There's this, okay? And you might say, well, Wayne, that's wrong. And I'm like, no, why is it wrong? You're like, because I lost money. Losing money doesn't make your trade wrong. You have to stop thinking that way. Trades that make money are not necessarily right. I've made money on stupid trades, and stupid people make good trades, and good traders make stupid trades. That is a good trade, and that's how you should lose money. The second way a bull should buy is off the bottom. Even if it dropped down here, that's also a good trade. Okay? But this is what would have happened in a risk-on world. And everything is right as rain, and all the economies are becoming more productive, and the increase in productivity lowers inflation. That's the good way of doing it. Remember, jacking up interest rates to slow the economy down and therefore lowering inflation is the worst way to do it. It's the worst way to do it. Okay? The best way to lower inflation is increase productivity. Okay? So like I have a tape measure on my, let's go this way. All right, here's a tape measure. Let's say it's $10 at Home Depot. Let's say I sell it to Home Depot for $5 and it costs me $2.50 to make. Okay? You see the logic? I sell it to Home Depot for $5, they sell it to you for $10. If I'm double my production, so let's say I make 1 million of these a year. Okay, so my company has $2.5 million in revenue. I take all that money and I borrow some through a bond offering, or I borrow some from a bank, and I increase our factory's capacity, and I double production from 1 million to 2 million. Okay, guess what? I continue to sell these to Home Depot for $2.50, but my cost is dropped by 30%. So by making twice as much, I increase my profit margin by 30%. Yeah. So then a competitor comes in and makes something very similar, except it's orange. Otherwise, it's pretty much the same. They're also selling it, right? Hey, did I get my numbers right? What did I say before? They sell it at Home Depot for 10, so I sell them to Home Depot for 5. So I have 5 million in revenue, 2.5 million in profit. Anyways, so a competitor comes in and makes pretty much the same thing, and they want to sell it at the same price. I can lower my profit by 30%. I can lower my price by 30%. which means my competitor would have to lower their price by 30%. I'm still profitable, and the competitor becomes not profitable because they're only making 1 million or 500,000 of these things, and I'm making 2 million. So my per unit cost is so low that I can drop my price, my Home Depot retail price to 7 and still turn a profit. And meanwhile, my competitor goes out of business because they'd be forced to lower their price, and but they wouldn't be able to make more. They would shut their factories down. They'd lay people off. And maybe I buy the intellectual property. I buy them out, and I get their factory, and I make $3 million a year instead of $2 million. You see? I buy them pennies on the dollar because I'm smarter. And of course, in the stock trading course, you learn about how corporations use the bond market to raise capital. You're like, well, what does that have to do with trading stock, Wayne? Why would you do bonds in a stock trading course? Well, think about it this way. The company that has better access to cheaper capital will be the better company to own. So if you don't understand how the bond market works, literally corporate bonds, if you don't understand how that works, then you don't understand like the cost of capital. So then how am I going to do like capital asset pricing model with you? If you don't understand the importance of, being able to borrow capital and the impact on the valuation of a company, you're not going to be able to pick the right company to invest in. Because why do you buy a stock? Because you believe that company can make profit in the future, and in particular, do better than the competitors. Well, if you don't understand the cost of financing, business cash flows or capital expansion, if you don't understand that funding model, then how can we talk about a corporation? Which one should you buy? And a lot of people will say, well, one company is $80 and one company is $8. Which one's more expensive? The $8 one could be more expensive than the $80 one. And you're like, wait. Well, you're associating price of one share with somehow being relevant to the valuation of a company. Well, no, that's not how you value a company at all. You might find the $80 company is cheaper. Cheaper in what? In terms of dollars? No. You might be thinking, well, maybe the $8 share has 10 times more outstanding shares, and therefore they're actually the same. Well, that's not what I'm talking about. I'm talking about risk-adjusted performance. You see? And all of a sudden, that's why we go through all these things. So it's, I think, terribly, terribly, terribly interesting. Take a look at some yens here. Okay. Aussie yen, fairly stable actually. CAD yen's been all over the place the last couple of days. I'm waiting for the up. So let's go to a smaller time frame here. And my strat right now is to climb this mountain. And I've been sitting here for days. And it's neither here nor there. It's not good, not bad. I guess really we should look at it from a daily point of view and zoom in here. And my thought process here is that, okay, there might be a kick this way. My risk now knowing what I want to know or knowing what I want to do is part of the battle. The second part of the battle is to know when I'm wrong. And the geopolitical risk here could just rotate this around. And I don't want a bloodbath. Okay? And I need to be ready to be wrong. Right? You guys ready to be wrong? It's the best way to be wrong. You're ready to be wrong. So yesterday I tried something new. We have a Tuesday meeting. Now I now call the week on the street. Oh man, I gotta go. So anyway, so we've been doing this for about a month or so, where I spend 90 minutes going over, a fairly deep dive on, news events, not necessarily fundamentals. I mean, yes, fundamentals, but, we go through all the news events, sometimes line by line. So like reading Christine Lagarde's speech to the IMF recently. And so one of the things I did after the meeting is I emailed everybody the 13 different reports that we reviewed for you to do follow-up. And what I recommend is that you print at least some of them out, print them out, and read the entire report with a pen and a highlighter. And so anyway, I sent that out yesterday, and several of you emailed me back, right, that this was great, it was good, it was helpful. So I'm glad. I like the new format personally. It's another means of forcing me to do my job. And my job is to read all these things that no one else is willing to read. And from us doing this together, your benefit is now you're doing the work that 99% of people won't do. But it's super productive. So it probably takes me 3 or 4 hours to prepare for our 90-minute meeting. And then I do a 90-minute meeting. So let's say I spend 5 hours doing this. But in the 5 hours, we create let's say 50 people watch it and do it with me. So therefore 250, so 300 hours of productivity produced from 5 hours of my time. And that makes me feel good that I'm doing this work, I'm getting the knowledge, I'm sharing it, and it produces 300 hours of productivity for my 5 hours of investment. And that smells good to me all day long. Like ribs on the Barbie. Okay. Anyways, I got a personal text, and there's a family-related thing that is absolutely needed for me to do. So I have to go. I got to bounce, in particular, get back to my seat by the time the stock market opens. So I apologize for that, but family always comes first, right? I hope you agree. My family needs me over the next 10 minutes, so I got to go. But thank you for being part of the Investor Bootcamp community. Thank you for being part of the Forex.Today community. Thank you for for everything that you do and stuff like that. Once again, you know, I don't think I'm going to be able to do the stock trading course today. I apologize for that. So we'll have to defer that. Yeah, I'll send out an email. Yeah, no, Jim, I won't be able to. I'm actually sick. So I probably don't sound like it, but yeah, I'm not going to be able to do it. So I'll send out an email. And I'll see you at 4, though. Right? Because, you know, the way I look at things is like, if I'm sick now and I don't feel good now, and I tell this to my wife and kids, like, nobody cares. I have to get up. I have to do my job. I have to trade. I have to make money. You know, the mortgage company doesn't give a crap that I don't feel well, right? So all that kind of stuff. And so at the market close, I have to be at the market close. I have to roll out of bed no matter how bad I feel, right? That kind of stuff. So, and all the other extracurricular activities can wait, but the markets don't sleep. The markets don't get sick. Nobody cares. There's no excuse, right? So, and my kids love that speech. Oh, you feel sick today? F you, go to school. So anyways, peace on earth. May the pips be with you. May your profits be above average. I love you, babe. That was real. Got to jump.